So in this video, I want to talk a little bit about Treasury stock. First of all, what it is, and then we'll go through the entries that you'll see in the chapter. First of all, Treasury stock occurs when a company decides to buy its own stock back from the marketplace. Now, when you read through the chapter, you'll see they give you some reasons for why a company might do this. There are some good legitimate reasons, like a company sometimes will just need extra shares on hand so that they can have those shares available to hand out to employees, like in a stock option plan or something like that. Sometimes there's reasons to, maybe stave off like a merger or acquisition from another company trying to come in and acquire your stock. But most of the times when these happen, or these types of events happen, it's usually because the company's trying to support their stock price. Now remember, the company doesn't actually set their stock price. Once it's already in the marketplace sets the price of their stock. And sometimes stock prices can languish or be reduced. And when that happens, one way to kind of boost their share price is to remove shares from the marketplace. It's just basically a supply and demand thing. So if the company goes in back to the marketplace and buys shares back, just like you and I would, less shares out in the marketplace would, supply and demand. Less shares, less supply would mean the price that those shares would go up in theory. So that's kind of a reason why a lot of companies will do these what they call stock buybacks and create this treasury stock. So the entries involved in this aren't too tough. There's a method that we use called the equity method to record treasury stock. So I'll just walk through a simple example of this. So let's take a look at this example. It says here that Park Corp repurchased 500 shares of $1 par value common stock for $6 per share. Okay, remember and recall that par value is just an arbitrary amount that's assigned to the shares. It's really most important when you first sell the stock for the very first time. Stock can't be sold below par value. But par value is usually non-consequential in practical sense. It does have some accounting applications, as you probably saw in some other examples, but it doesn't have a lot of real functionality, in kind of recording real transactions day to day with stock transactions. And that's the case here too. We're going to actually ignore the par value here. We're going to use what's called the cost method to record these treasury shares. So if we bought 500 shares and the stock price happened to be $6 per share, all we'd have to do is take the $500, multiply it by the $6 per share, and it would mean that we'd have to pay out $3,000 in cash, 500 times 6. $3,000 in cash to acquire this treasury stock. So just like you and I go on the marketplace, we just go back in, we pay out the $3,000 just to buy these shares back from the marketplace, and we record a credit to cash, and we record a debit to an account called treasury stock. So when I look at my T accounts here, this is exactly what that entry would look like. Now, if you're wondering what kind of account treasury stock is, it is a contra equity account. Remember, contra again means what? Opposite. You notice that we increase the treasury stock account on the debit side, which is opposite of where we normally increase equity accounts. So it is an equity account, it's just a contra equity account, all right? Okay, so now what can happen with treasury stock is a company can buy their treasury stock back, record it as such, just like we did. They might hold on to those shares for a while in-house, and then maybe a few months later or whenever, they might sell some of those shares back to the marketplace. So let's take a look at number 2. Number 2 says Park Corp later sold 200 shares of its treasury stock back to the marketplace, and they sold it at $8 per share. Basically, they're going to sell it at whatever the marketplace price is at that time. So you can see we bought the shares at $6. We're going to sell it back to the marketplace for $8. Sounds like a pretty good deal, right? So we're going to record this. The first step that you want to do here is, first of all, just record the impact of cash, because we're receiving cash here because we sold these shares back in the marketplace. We're receiving cash at $8 per share. 200 shares, there's the amount we sold back. So what's 8 times 200 is 1,600. So we're going to start by having a debit to cash of 1,600, correct? So we're going to start there. That's going to be the first part of your number 2 entry. Now, the next thing you're going to have to do, and this is just something you kind of just remember with the way the cost method works, but we're going to need to impact the treasury stock account, of course, right? Because we're going to need to reduce it, right? We're going to need to reduce it with a credit. The trick, though, to reducing this account is we're going to reduce it at the same rate that we added to it. In other words, remember, we put the treasury stock in at what? $6 per share. So we're going to take it out at $6 per share. Okay, so at the same rate we put in, we're going to take out. That's just the way to remember it. So if we sold 200 shares at, we're going to take it out at $6 per share. 6 times 2, that's $1,200. So I'm going to credit $1,200 to the Treasury stock account. Okay, $1,200 to the Treasury stock account. So my entry so far is I've got a debit of $1,600 to my cash account, and I've got a credit of $1,200 to my Treasury stock account. So obviously I'm not done here. My debits have to equal my credits, don't they? I'm off by $400. Well, that $400, I need another credit to balance this out, don't I? Debits have to equal credits. That $400 credit is going to go to this other account here. You can see here called paid in capital in excess of Treasury stock. Paid in capital in excess Treasury stock, or excess of cost Treasury stock. Kind of a long name. Some people just call this an additional paid in capital account. So if you see that, that's also another name for this. But that balances out our entry. Now, again, you're probably wondering what kind of account that is. That is an equity account as well. Now, if you really think about this, that might seem strange, because if you really think about it, we bought those shares for $6 per share. We sold them back to the marketplace for $8 per share. So we basically earned $2 per share times the 200 shares, or $400, right? Kind of like a gain. It's kind of like if you think about like back to the asset chapter, when we sold an asset, we, sometimes can record a gain, on that if, we sold it for more than our book value. It's a little bit like what happened here in a way, but here's the thing. We can't record that $200 to a revenue account of any sort, or a gain account. And the reason is because the Securities and Exchange Commission, the SEC, you may have heard of those guys. They're the regulatory body for the stock market. They don't want us recording this as a gain, even though it kind of was, right? Because they don't want us recording that onto our income statement and helping boost our bottom line, our net income. And the reason is because they don't want us to kind of get into this speculating, buying shares and then turn around and selling them for a gain. I mean, think about how that could be abused, right? I mean, for instance, you could have let's say you are a pharmaceutical company, and let's say you've been researching a drug for 6 years, and your stock price is at a certain level because nothing's really happening. And then all of a sudden, you get knowledge that the FDA is going to approve this big drug for you that's going to make you billions of dollars. And, so the company has that knowledge inside. Nobody else has that knowledge, but you have it. And so let's say you go out to the marketplace, you buy a whole bunch of shares back from the marketplace at a really low price. You bring those back in, the FDA then approves your drug, and then all of a sudden you sell it back for this huge gain and then record that on your income statement. The SEC doesn't want us doing that. I mean, this is not something that's to be encouraged, even though, yeah, this stuff kind of goes on sometimes. You don't really want that to be encouraged, right? I mean, if it kind of happens innocently, like in this case where you bought it for 6 and sold it for 8, but you really had no inside knowledge of it, the marketplace was just moving around, that's fine, but they still won't allow you to put it to the income statement. So you just got to remember that there's no gains or losses on Treasury stock. So it all goes through that equity account. And they don't care so much if it's on the balance sheet. They really care whether it's on the income statement, okay? All right, one last step to this. Though, let's say that, remember, we originally purchased 500 shares. Let's say in step 3 that Park later sold another 100 shares, let's say a few weeks later, a few months later. But this time, the market price dropped to $4 per share. So in this case, we're only going to receive, $400 in cash from the sale. So we put a debit to cash of $400. Now, remember, in Treasury stock, we're going to take it out at the same rate we put it in at, right? So we put those shares in originally at 6. So we're going to take it out at $6 per share. So 100 shares, $6 per share. We're going to credit the Treasury stock account for $600. So now look at my entry number 3. I've got a debit to cash of $400. I've got a credit to Treasury stock of $600. Now I need a $200 debit to balance out my entry here, my 3-line entry, don't I? It's going to go to the same place. We're just going to put it to that additional paid in capital account. But this time it's going to be a debit because it's functionally kind of like a loss, right? In this case, even though that's going to still go to the equity account. And that should balance my debits and credits. So be careful when you're doing these entries. Just make sure at the end that your debits and credits all balance out, and just remember which accounts are involved in these Treasury stock transactions. All right? If you have any questions, you know where to find me.